Today, folks, we need to talk about what the heck is going on in the economy because it is absolutely insane, to say the least. And before we do, as Canadians, we really need to applaud ourselves on the general intelligence. As I was scrolling through basically Blossom, I noticed the most bought stocks were ETFs, and people have been coming to my website, kylelivingston.com, and actually booking one-on-ones from early 20-year-olds to people heading close to retirement, to men, women, everything in between. And I'm just like blown away because I did not have half the intelligence most of you do when I was younger, and I'm just shocked at how a lot of people heading into retirement are getting into self-directed investing, and they're doing it in such an intelligent, methodical way that I think we just deserve to applaud ourselves. Now, I know the degenerates are out there, and a lot of people think the world is filled with degenerate investors that are just buying absolute crap coins, but you're not. I think a lot of us have learned from this community, and I'm ever grateful to see us all kind of lifting each other up. Now, on that note, we really need to talk about what is going on in the economies, because the U.S. economy is starting to take off today. I want to talk about why, as the Canadian economy is struggling a little bit, but I think there's still some hope, some signs. We need to talk about the tariffs, what that's going to do to the Canadian economy. We had U.S. bank earnings, and I want to talk about how that relates to the Canadian bank earnings that are going to come up. We'll talk about oil, energy, interest rates, and so much more in between. So if you're on the path to financial independence, if you one day want to retire early like the rest of us, hit that subscribe, join me on that journey. But let's get into this, baby, because U.S. core CPI, yes, we're going to talk about the boring stuff. We have to, because it's really affecting both our economies here. Inflation came in at a level that got everyone excited that they might cut interest rates faster, and I don't think they are in the United States. I have some underlying secret information that I think the Fed's playing around with that they don't publicize when they're talking about consumer price index, because they're telling us this is purely what's controlling the interest rate environment in the United States. And honestly, I don't know what there was to celebrate, because CPI still came in relatively high. In total, it rose 2.9% over the trailing 12 months, and it rose 0.4% for the month, which is honestly trending back to the upside heading into 2024 or into 2025, to say the least, the end of 2024. So where this goes from here is not in a good place. If you zoom out, you look at the last 10 years, you can see that the US is still experiencing relative high inflation to the past, which is why they're keeping interest rates up supposedly. Whereas in the Canadian economy, and a lot of other economies globally, inflation's largely cooled down on the back of a cooling and more depressed economy. Canada's on the brink of a recession. We haven't hit one yet, but we're not teetering on any real growth rates like the United States still is. However, if we look at the interest rates here in Canada, we're now down to 3.25%, whereas in the US, they're still hovering around 4.5 points. And I really want to point out that Canada has a meeting coming up. You can mark the date, January 24th, so we can see if they're going to continue to cut rates here in Canada. But if they do, say goodbye to our dollar. Our dollar is going to continue to get weaker, and it's not really a great thing that's going on here, because globally people have been cutting rates across the board because they're not just, no one is as strong as the US right now. Their companies are on an absolute tear, and what this causes is people like me, other people that want to hold fixed assets that aren't at risk of equities or more volatile markets, they're going to go to the United States because they can get government-backed debt, bonds, treasuries, whatever, at much higher rates in a much more stable environment where their dollar is continuing to get weaker. So they're getting kind of a double-edged return. So when they sell those, fixed assets, they can convert them back to their native currencies, and they're just going to see a much better return. That's what we've seen in Canada. That's what Europe, most countries, their dollars absolutely get decaying because of the reality of interest rates. And this is why I don't think the Fed is going to cut rates anytime soon. I think they're actually enjoying this, because if you take a look at the United States dollar, it's sitting at 20-year highs. It's stronger than it has ever been in a very long time. And all of this really bodes well for the US economy, because though commodities, like we talked about yesterday, cocoa, sugar, a lot of commodities are still relatively inflated, but those commodities are sold globally. So if you're in the United States and you want to buy sugar or some global product anywhere else in the world, guess what? Though the price might be inflated, it's being offset by the strong USD on the import. So this is hyper peculiar. It's very complicated at best, but I think the Fed understands this, and they're not really going to talk about this. And I think they're just going to completely state that it has everything to do with inflation, whereas I don't think it does. I think it continues to maintain the strength of the United States dollar, and that is some part of it that's just under discussed. But let's kind of pivot a little bit. Let's talk about stocks. Let's talk about where Canada's headed, where we sit, because we've been recently getting some insight from the U.S. banks. And I have to admit, I am absolutely blown away by the performance of the financial sector over the last year. Right now, because of earnings, there's been 5+% returns in most of the major U.S. banks. You look at the 1-year return, they are outpacing, all the markets for the most part. You look at the 5-year here, and it's just been, insane. Most of the returns over the last 5 years came with just in the last year. So congrats to anybody that's been holding U.S. financials. But if we take a look at JP Morgan, I want to talk about, some of the returns here and why they've been bolstered so much. And very similar to the insurance companies, JP Morgan has scale. They have a lot of cash and they are making bank on interest income, right? It's been like one of their best performing aspects of their underlying returns. But if we take a look, the one thing that I find really interesting is this could help give some insight into the Canadian banks, because the Canadian banks are still doing well, but they're not in any particular place that isn't unsimilar to the United States. And I can tell you that with confidence because of the provisions for credit losses, which are still relatively high, and they are trickling down year over year now, which is a great sign in the United States, which means, if our economies are that similar, we could see a cooling of provisions for credit losses, which we have seen with some banks in Canada already. This is a good trend to start seeing because it's going to be bolstered better returns. But on a percentage basis, I do want to remind you, it's kind of incredible to think with the huge amount of money that JP Morgan makes here. I mean, we're talking about $42 billion, right? And they're putting about $2.6 billion away for this quarter, that the recent quarter release for Q4 of 2024 of $2.6 billion, which on a percentage of their revenue is 6.1%. So 6.1% of the revenue is just going for potential delinquencies in loans. We look at Royal Bank, the biggest bank in Canada, which only makes $15 billion, which is pretty measly compared to the whopping $42 billion JP Morgan makes. But when we look at provisions for credit losses, they're sitting at $840 million, which unfortunately, compared to some other banks, has actually increased year over year. So I'm very excited to see what the next quarter report looks like, which we don't get, I think, till mid-February. So we're going to have to be patient with that. But on a percentage basis, Royal Bank is actually putting lower loan loss provisions aside on a percentage basis than JP Morgan. And I think that data is just super interesting. And it does show some signs that, some of the Canadian banks are even in a stronger position, even with the loan losses they're putting aside. So I'm very intrigued to see what happens from that aspect of it. But if we take a look at the broader TSX and we talk a little bit about Trump, and if we're going to head into a recession, and I really want to tell you guys to calm the F down, I've noticed a lot of investors and some of the personal conversations I've had in those private chats from the one-on-ones, people are really worried and they think that they can stack cash. They think they can outsmart the market. And I always feel like when news and the rhetoric starts to go like this, people start doing stupid crap. They start predicting, they start speculating, and they don't realize that they're giving up on their cost average strategy, which is something you just cannot do. Because then moments like this hit where the markets start to pop off, and then you feel like a bit of a moron not buying some of the dips, and you didn't keep on your cost average strategy because somebody convinced you the whole world was going to collapse. We don't know what tariffs are going to do, and I think they're absolutely moronic. I think Trump isn't like, I don't know what the guy's going to do. Nobody does. From every personal angle, it looks ridiculous because it's going to hyperinflate the US markets. It's going to cause massive inflation. And I think he's just using it for negotiation tactics. But oil and energy in Canada has been popping off, and this will be the sector that gets absolutely devastated and cause a recession if we see that 25% tariff or whatever Trump wants to do. Oil has been a bit stronger into the beginning of the year here, and the energy sector has been what's really driving some of the major returns in the Canadian markets. But the Canadian provincial leaders apparently are in disarray over the Trump tariff threats. But we recently saw, we've been seeing a lot of like Doug Ford here in Canada, like a lot of our representatives are standing up, and they're trying to give some Canadian inspiration here, which I think is good at least. But I want to show you that the market snapshot for almost all Canadian crude oil has been basically going to the United States. This is the craziest data I've ever seen. So look at this. Almost all Canadian crude oil exports went to the United States in 2023. And there's kind of a graph that really shows you how insane we supply the United States with oil. And if this gets 25% tariffs, what it would do for energy prices in the US would be just astronomical. Like, I don't think people appreciate the insanity of what Canada supplies the United States when it comes to energy. And even still, these economies are so integrated. When you look at companies like Enbridge, which are now like basically pushing all-time highs, performing exceptionally well here, year to date being one of the best performers. Incredible to see. But if you take a look, like the integration of these pipelines, regardless of if Trump wants to start, producing oil out of the United States, they're going to be using the Canadian companies to blood flow the entire Western world. I love Enbridge for this reason, right? Because regardless of what you think is going to happen to energy, you cannot deny the fact that all that energy is going to be flowing through the majority of Canadian company pipelines. Like, there's just so much integration between our economies that it just doesn't make sense. I mean, look at something like Suncor, for example. Suncor owns the Canadian oil sands, very integrated between the US and Canada. If you take a look at the integration, It's insane, right? 50% of North American retail sites are Suncor owned. North America, not just Canada, North America. Like when you're going to a lot of these gas stations, when you're like, it's just so insanely integrated. So I'm very curious, and I wish Canadians would stand up and be like, hey, this is insane. Let's see how this pans out, because it's really going to hurt both their economies, and we'll see what the negotiations actually lead to. But I'm not going to gamble on that. I believe these companies are strong regardless of policies. I will continue to buy them regardless of policies, especially when people see it as a sign of weakness. Just opens up a better buying opportunity, and we'll see how those cards get laid out. But honestly, I am just super fascinated by these conversations, and I'd love to know what you guys think in that comment section below.